Good morning and welcome this morning to Trading Futures, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. Just heard the opening bell there ringing in my ear, which means that the market is up and moving. That means we're getting going with this. Joined out there in the chat by my good friend Brent Moores, great educator in his own right, good friend. And he and I have been working together for the better part of 30 years. So it is always a good idea to take a listen to what Brent has to say in any of his webcasts. I'm glad to have him there in the chat, helping to manage those conversations going on. If you're here with us live, welcome. Be a part of that conversation by chatting in your questions and discussion into the mix. If you're here in the recorded version, you can be a part of the conversation as well by leaving us a comment in the comment section. So we appreciate that. As we get into this discussion this morning, we're going to talk about a variety of things. Some of the things that are moving this morning, we're seeing again those NASDAQ futures down a little bit. We're seeing some drag on the global semiconductor space for sure. But perhaps one of the things that is moving the futures market, or perhaps holding the futures market in stasis, at least in some areas, is the fact that we have the start today of a two-day Fed meeting. In fact, that first one for Kevin Warsh. And question is, does he come out and announce his position with authority, or does he maybe walk the status quo, or maybe do something completely different? And that becomes the concern for a lot of futures traders in kind of positioning ahead of that. Now, we'll get into that discussion as we jump into the specifics this morning, but a couple of quick housekeeping items as we get started. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation or solicitation of a particular account or strategy or symbol or anything else. Make sure that you understand that futures and futures options trading involves substantial risk, is not suitable for all investors. Make sure that you have read the risk disclosure statement for futures and options prior to considering trading any futures products. There are additional disclosures from the CFTC and NFA futures and Forex comments that are a good idea to read. Remember that futures positions, in order to initiate a futures position, a performance bond, or an initial margin amount, is required to be held in your futures account to establish a futures position. Remember that futures trading requires separate trading authorization and a specific futures account. That futures margin or initial margin is what is required to initiate a position, to hold a position. A maintenance margin amount, which is oftentimes lower, is required. So it's not as if we're necessarily buying or selling the contract specifically. We're initiating a long or a short position and benefiting from price movement. We'll talk about that as we get into this scenario and some of these specific discussions. All right. So one of the things that I want to make sure that you have an understanding of is the fact that investing involves risk. Most of you have probably heard that before, but the comment that I want to make regarding futures is that for some products and strategies, including futures products, there is the potential for loss of more than that initial investment in the trade. Futures markets can and do move quickly at times. Now, stop orders when it comes to futures products are not guaranteed in execution. They behave differently than equities due to exchange rules based on certain conditions. The exchange may reject or substitute an exchange-designated limit order for the originally triggered market order. So any order that generates a market order, buy stop, sell stop, doesn't matter. That is going to get executed as a limit order determined by the protection range or protection band determined by the exchange. Now, we're going to talk a little bit about virtual currency derivatives, i.e. cryptocurrency, as well as others in this discussion. Remember that they involve some unique and significant risks. I talked a little bit about this yesterday in my cryptocurrency basics webcast, but just a quick reminder, read the NFA advisory and the CFTC customer advisory on virtual currency trading. Uh, those risks associated with those products are still emerging and developing. So it is not settled science, if you will, when it comes to those risks associated with those particular products. Also, remember that we're going to be using the Thinkorswim desktop software platform, specifically the paper money version of that platform. Not a guarantee future success out there in the real world. Great learning environment, but it behaves a little bit differently than a live trading account, especially in the area of fill prices. Fill prices in a paper money account are oftentimes filled at the algorithmically derived midpoint, whereas a live trading account is going to fill based on market forces at work in that specific product. So again, past performance, no guarantee of future results. We're going to jump into this discussion here really quickly, and I want to take a look at what's going on in the market this morning. And as we get into this discussion, here is the S&P 500 E-mini contract. And hey, welcome to all of you. Welcome to a bunch of you. So as we get into this E-mini contract, a couple of things are going on. We talked a little bit about this last week, and I kind of highlighted some of the circumstances that are at play in the market at the moment. Starting to see kind of this bouncing down from a resistance. The market has had, futures market has had a hard time, and likewise the index, a hard time cracking this 7,600 resistance level. In fact, it's now tested it once, twice. You call that 3 times, maybe 4 times if you were to look at that little pullback there, but I'm going to call it 3 times, generally testing that resistance level, moving back down towards this support, breaking through in the last 2 trading sessions below that 50-period moving average. 50-period moving average now rolling off a little bit. However, if we take a look at where the market is relative to the last time it was down here, we see that the RSI is a little bit higher than it was. We're at a slightly higher low on the price of that futures, that continuous contract, slightly higher low on the RSI. So that would suggest perhaps that in the short term, there is still a little bit of upward momentum, even though in the downward trend of the ES, it's still kind of pushing in that downward direction. But you can kind of see that 50-period moving average acting as a level, what was a level of support, now potentially acting as a level of resistance. From a horizontal standpoint, the 73.62 level might be the next area of some previously tested support, if you want to look at it from that particular standpoint. All right, so now as we start to look through perhaps the bigger issue, and this is a little bit different. One of these things is not like the other. One of these things just isn't quite the same. We've got a breakthrough in the NASDAQ futures. This is the /NQ, and I'm just going to move this horizontal over here a little bit. We saw a break of that horizontal. We've seen this trading under the 50-period moving average for some time, about a week and a half, maybe 2 weeks. Broken below this support level, broken below kind of out of that range of price discovery on that support level in the last 2 trading sessions, and maybe continuing to move to the downside. The symmetrical move to the downside here would put price down around that 26,773. And from that standpoint, starting to see that move to the downside with some increasing downward momentum becomes a little bit more likely. So what I suggested and talked about at the beginning, kind of in that intro, one of the driving forces here is the fact that once again, we have the overnight movement in the South Korea index, the Kospi index, down over 10% to the downside. Now, that's been one where that market has become extraordinarily volatile. There have been in the overnight hours a couple of, on the Kospi index, a couple of algorithmic trading halts because some of those tech bellwethers on that index have been moving pretty strongly to the downside. So Return on investment, earnings becomes the concern, valuation relative to AI spending. Those are some of the concerns that are perhaps driving this to the downside. Now, K. Brown says something, and I think this is an interesting comment. RSI suggesting that it's becoming oversold. We're not quite there yet to that oversold range. We're still above that 30 level on the RSI. Now, one of the things that we have to remember is that the RSI, just because it becomes oversold, doesn't mean that that's a turnaround point. It can be, but like we see here in the top side, when we get up into that overbought range, the market can sit in that overbought range for some time and still continue to move to the upside. It just simply means, I think, kind of an extreme level of downward momentum. But you're right, and I would argue that probably K. Brown, that your comment has a lot of prescience to it, because this gives it a little more room to move to the downside before, in fact, it gets to that level of being extreme, right? Extremely overbought, or excuse me, in this case, oversold, which would be an indication of that move below that 30 level. So that presents maybe even a more bearish scenario. But again, that's what technical analysis suggests. The reality of the situation is going to be borne out in terms of what this futures contract does. But in a longer term basis, you've got a couple of structural levels, and it doesn't matter what the symbol is. If we were to put our left thumb over the symbol on this screen, and I'm just going to do that right here, kind of virtually, right? I'm going to put my left thumb over the symbol on the chart, take the story out of the discussion, and if I were looking at this from a technical analysis perspective, those levels. Let me grab my annotation tools here real quick. Those levels that we're starting to see there, this break of the support right there, this break of this kind of price discovery level, and the fact that we've got this breakdown to the downside out of that range in the RSI would suggest that there is more bearishness afoot here in the NASDAQ futures. Doesn't guarantee it, but that's kind of the perspective. And if we were looking at it from that standpoint and saying, hey, you know what, I don't know what the symbol is, I would look at it exactly the same way, not knowing the story about the South Korean index or anything else. So that's just kind of the perspective that we take when it comes to technical analysis. Now, taking a look at the Russell 2000, again, one of the concerns here is what has been going on with interest rates. So what I'm going to do is I'm going to put on here a comparison chart really quickly, and COMP comparison chart, because I want to get a sense of what those interest rate changes might be ringing here. So I'm going to take /10Y, whoops, 10Y, which is the micro 10-year yield. Now, this isn't we're not talking about the long end of the curve. We're talking kind of right in the middle of the curve. It's not the 2-year, which is generally a driver of institutional products. 10-year is generally a driver of retail credit cards, auto loans, home mortgages, those types of things, as well as small business borrowing. And that's why we're going to use the 10-year as the relationship that we're going to do the comparison here, because those small caps that are contained in the Russell 2000 are generally making and taking loans on that structure based on the 10-year. I'm going to change this lower symbol, or this lower study, to our correlation. So I'm going to take a correlation study, and I'm going to put that correlation study down here on the bottom, /10Y. We'll put that in the mix as well. And we can see that there's kind of that inverse, more often than not, inverse correlation. Sometimes there's a little bit of positive correlation, and oftentimes that comes after there's this kind of decoupling. But we're kind of at that point now where that relationship has been somewhat inverse. When yields go up, another way to describe that is when rates go up, the Russell tends to fall. When rates go down, the Russell tends to gain. So here's the thing. We're at the cusp of this Fed meeting, right? Russell 2000 is sitting at in this case, the E-mini Russell 2000 futures, sitting at that horizontal support, roughly, right about the 29.34 level. It's also sitting right at the 50-period moving average. 200-period moving average still been moving strongly to the upside. But as we start to see those rates coming down slightly, 10-year slightly down in this particular case, ahead of this Fed meeting, that may be one of the driving forces here. We may see a potential bounce in the Russell 2000 if the Fed holds rates the same. If the Fed comes out and says, hey, we're going to, as I borrowed from Cartman, announce our position with authority and raise rates and say, this is not your father's Fed of last year. We're going to raise rates here in this circumstance. Then we could see the Russell 2000 break this horizontal support level. Again, remembering that inverse correlation. If for some reason, which is there's also that potential, because we've got to think about it in terms of all of those potentials. If the Fed says, hey, we're in fact going to cut rates in this case, which I think is a lower probability, but again, that's simply based on the Fed funds futures, which are somewhat becoming disconnected, if you want to think about it from that standpoint. But if we're looking at this as a potential, and we see that maybe that possible bounce here, that may come on a cut of those interest rates, or maybe even leaving the rates the same. Again, with that inverse correlation being in that particular case. So that's kind of the scenario at work here. A couple of other futures contracts I want to look at. I'll just keep it on this particular grid for a moment here, and I'm just going to pop these in. We can start to see those NASDAQ futures accelerating to the downside. We'll go and take a look at them here in just a moment. But /CL, crude oil, one of the concerns that we've been having. Obviously, a little bit of a downward move last week when we were talking about this. We unwound that futures calendar spread, our September, November calendar spread, where we were long the back month, the November, and we were short the September. Hindsight is 2020, right? And we were in that period of time where that was moving to the upside, and unwinding it made sense at the time. Now something is perhaps changing a little bit. We're seeing that downward movement. Now, nevertheless, crude finding perhaps a little bit of a support level here. So we'll take a look at that as well in this mix. So what I'm going to do is I'm going to pop over here to my futures grid, and we'll take a look at a couple of things that are going on. Here is /MNQ. And this is the micro NASDAQ futures contract. And what I'm going to draw in here is just this level of support right here. So this is something that I was watching this morning, and this move happened very, very quickly. And we've kind of talked through it, but we've got a very strong move to the downside. This is a 5-day, or excuse me, a today 5-minute chart. Starting to look at that on a shorter term perspective. This is normally what we look at. This is what we were just looking at on that 1-year chart, and starting to see that downward movement below that discovery level. So still starting to see that downside move. We've got a resistance level now that is in place on this short-term perspective. So real quick, before we enter the trade here, I'm going to pop over to this grid. We're going to walk through this for those of you who are brand new to this discussion. Tick size, tick value, point value, notional value of the contract. Tick size is the minimum increment of movement. And we're starting to see this. Here's our price. You see that the minimum increment is 0.25, right? Tick value is 50 cents. So every time that ticks from 0.5 to 0.75 or 0.5 to 0.25 or 0.0 to 0.25, that's 50 cents of movement in that price. So a point value move, if we get a move on this point just to the left of the decimal, that's $2 in terms of the contract price. Risk in the futures contract is another word for notional value. Take that point value times the price. That gives us our notional value of this contract. And our initial margin into this particular trade is 4,967 if we're going long. Going short, it's a little bit lower, $4,743 per contract in initial margin. And that's one of the reasons why, in this particular case, we're looking at the micro contract versus the big contract. Because if we were to take a look at forward slash NQ, I just saw it. I moved right past it. Forward slash NQ. Now we're talking about $49,000 long, $47,000 short in this particular case in terms of that initial margin. So from a capital efficiency standpoint, depending on the size of the trading account, that futures might be a smaller component of that. So what we're starting to get here is this little bit of a bounce. Big hammer candle right here. I'm going to zoom in so that we can see this. So my thought is this, and we think about how we might go short in terms of a perspective like this. And it comes back to the same idea that we've used whether we're trading equities, whether we're trading futures contracts intraday, whether we're trading equities long term, doesn't matter. Still in this kind of discussion of how we verify or confirm a move to the downside. So we get this little bit of a pullback, right? We get a downward move, a little bit of a pullback. We got a little bit of a pullback. We got a green candle. So the methodology in this particular case would be potentially a trade below the low of the high day in this pullback. So the high day in this pullback, if you want to think about it from that standpoint, this is the pullback. That's the high day in the pullback. So what we're looking for is a move below this low right here at the 27,655 level. I'm just going to put a line right there. We're looking for a break below that level. That suggests confirmation of this move to the downside. And you say, well, wait, why don't we just get in now? Because this could bounce. That candle could be a turning point candle, right? Could give us a move back to the upside, that big hammer candle. But a break below that level now gives us some confirmation, not a guarantee, but some confirmation of that downward movement. Notice the ADX, still strong momentum to the downside. This is becoming a very strong trend. In fact, that ADX sitting up here at about the 58 level, still a very strong indication to the downside, 58.25. And you notice this bounce that we got right here. So now our new level for entry in this trade, since we now have this next candle, becomes this. And since I've been talking about it, I wanted to talk about this for just a moment. I'm going to activate that drawing and I'm going to bring it right back up here. This becomes our new high candle in this pullback or rally back up, right? This counter trend move. That becomes our new high candle. So the entry point becomes a break below 27,699. It changes. So now we're going to put the trade on before I continue to talk through this. The idea being, and we might get that move here in just a moment, I'm going to add a little bit of room to the downside on this chart. I had about 20% to the upside. I'm going to add 30% to the downside so that we can see that room. So here's what I'm looking for in this short-term move. There's our support level. I'm going to duplicate that. I'm going to take it, I'm going to put it right there on that breakdown. And that's going to give us our target, in this case down here around that 27,339 mark. Our stop is going to be right here. So I'm going to just label these really fast. And then we'll put this trade together. So this is going to be our stop. Whoops. There we go. Stop. This is going to be our entry. And this is, why did that not, that's weird. Okay. There we go. And this is going to be our target to the downside. Oh, it's because I was hitting the control key. There we go. I had to move my finger a little bit and maybe learn to type. Mr. Koenig from middle school type class would be terrified of my typing abilities these days. All right. So that's going to be the trade that we're going to look at here in this perspective in terms of this entry. So I'm going to right click and we're going to do a sell custom with OCO bracket. And again, this is not a guarantee. This is not a recommendation. This is simply an illustrative example. I know my numbers here. My entry price is going to come on a sell stop below 2770. 2770 is going to be our sell stop. So we're going to make that a stop. And 27,7 is going to be our trigger point in this trade, and we're just there now, right? So we've broken that. Now, the stop to the upside, that buy stop to the upside, is going to be up here at around 27,844. Let's make it 27,8. I'm going to make it 27,850, right? And so this is going to be a buy stop, 27,850 is going to get us out of the trade at that point, or close to that point. Not a guarantee that that's going to be where that order fills. That's going to be our stop. Now, our target to the downside is going to be a limit buy order, and we're going to make that 27,3. I'm going to make that 27,330. 27,330 is going to be our buy limit order to get out of the trade. We're going to, of course, make those good till canceled. And I want to make sure that we make those to close and to close just in terms of that methodology, making sure that that is, in fact, what we're trying to do. So now we could enter this as a market order. It's already triggered our stop in this particular case. It's doing what we've expected it to do so far. But if I click on confirm and send, I'm going to read through this order. We're going to sell it at that sell stop, 27,700. We're going to go short, initiating a short position in this futures contract. We're going to buy it back if it goes up to 27,850, or if it goes down to a limit price of 27,330. It says limit, buy it back at this price or better. And when you're buying something, or better is less. So that's why we use a limit order in that particular case. Initial margin into the trade is what we talked about, 4,967. Since we're going short, it's a little bit less than going long the position here. And I'm going to put this in our futures group. Click on send and fire this order off, and we'll see if that order fills for us here in terms of now we are short this position. So what I can do is I can come up here and I can say show orders, click on apply and okay. And there's our target to the downside. There's our target, our stop on the upside, and looking for this to continue to move to the downside. Now, there's no guarantee here. Just because we had that trade below the low of the high day, there is no guarantee that this is going to continue to move to the downside. However, that gives us some confidence that at least this little bit of a bear flag may become a continuation pattern, and that's the move that we're looking at trading here in this shorter term time frame. Now, are there other indicators you could use? Yeah, absolutely. But this is simply using a fairly quick signal in terms of these 5-minute charts in terms of getting into that trade, right? So that being the case here, looking for that movement, we'll keep that in mind as we start to watch this move. Now, I want to come over here really quickly, /MCL, that micro crude contract. And I want to go back over to our left-hand side and see what's going on with this particular contract. And we've traded this a couple of times. In fact, this is where we have put that futures calendar spread on, and we unwound it last week. So I want to think about maybe what's the possibility in this particular case of putting something similar on. Now, we could go simply short this contract at this level. We're kind of sitting right there at that 80 mark, that 68, 79, 69, 70 level or so seems to be a level of support that has been kind of one of those strange attractors recently. You see where that level of support has been touched a couple of times, and we've seen a draw down to that level. One of the reasons for that is because that's just about where the lifting cost on average is for crude oil. Now, the additional is going to be risk premium and a few other things, demand. But if we're seeing that move to the downside, that could likely be an attractor just because it's a level of resistance in this particular case. Excuse me, support in this particular case. Downward momentum. So we've got that possibility of that move to the downside. What I want to do really quickly is if we go to the trade tab here for /MCL, I want to look not just at the current active contract, which is this September, the one that we unwound last time, but I want to scroll down to the bottom of this trade page to the product depth discussion here. And we're going to come down here. We're going to make sure that this is on futures. And this is taking into account all of the delivery dates going out into the future that are currently available. And if you scroll through up here, you see that there are deliveries out to December 29. Now, not a lot of activity going on in those particular contracts, but they do, in some cases, have a price. They may have a bid and an ask that might be wildly different from one another. Um, but they do have a price, and that factors into this curve. So we're going to kind of rationalize this curve a little bit more. We're going to take this into account. We're going to say, all right, we don't want all 40 series. I just want to deselect those. I want to select the front month. I want to select October, November, December, and maybe over into January of next year in terms of what is being shown in this curve. And now we're going to look down here. We're going to see, all right, if we scroll down just a little bit, you can see that backwardation is still in place here. Contango would be exactly the opposite. Contango is the usual expectation. We see contango a lot in things like Bitcoin futures, those types of things. But that contangoed curve would look something like this. That expectation of rising prices out into the future because of uncertainty. This is, on the other hand, what's referred to as a backwardated curve, because here's our current active contract. Let me click off of here really quick, and we'll scroll back up in this list. There we go. Now I'll grab my magic marker. This display right here is our active contract with 22 days to go until expiration. Here's our January contract, and that is 143 days to go until delivery. And you can see the price difference. So our current active contract is priced at $81. Our January contract is priced at $74. And to initiate a future calendar spread, or what's sometimes referred to as a time spread, the idea being that in this particular case that we might see downward movement in the active contract and some upward movement in the long dated contract, and that eventually these prices are going to get somewhere closer to one another, because at expiration all of these contracts by necessity are going to move to whatever the spot is at the time. So if spot is trading higher because of geopolitical risk, then that price is going to move up. If spot is lower because of demand destruction or supply, then that price is going to move down to meet that spot price. So our expectation in doing a calendar spread would be going short. This is one calendar spread that we could do, expecting that in the front month that higher price is going to come down. We would go short the active, which is the September, and we would go long the January. So several of you have asked me to kind of explain what it is that we are trying to accomplish with this spread. So if we look at this right now, we would look at the difference between these two. If I were to, what I'm going to do is I'm going to change this display, and I'm going to keep this this down here on the bottom. But I'm going to change this display from single to calendar spread. And I'm going to look at this one right here, which is the active. And I've got those relationships. I'm going to kill those drawings just so they're not getting in the way. But if we're looking at, say, for instance, the September, January, which is what we were just describing down here on the bottom, we can see that the September, January calendar spread for micro crude oil is currently trading at $10.89. That's the price difference between those two contracts, between the September contract and the January contract, right? That's the price difference between those two. So what we're looking at doing is selling overall, that spread, because the expectation is that that spread is going to come together, this price is going to get smaller. That 1089 difference between those two is going to decrease, and we're going to benefit by being able to buy back that spread at a later date for less than we were paid for it. Essentially, what it comes down to, for less than we were paid for it to begin with, or less than we brought in initiating that position. So we're going to initiate this calendar spread, and we're going to watch this. Now, we have a couple of different roll opportunities here on that front month, and at some point we're going to have to roll the September into the October and maybe keep that January alive. So this is betting on, or to not use that verbiage, this is speculating on the front month, the September coming down in price, and the January either staying where it is or going up. Ideally, if it were to go up, the January price were to go up, that'd be great. Or if the September were to go down big, that would be great too. So we're going to go ahead and we're going to initiate a position on this. So one of the things I'm going to talk about here is if we drop this down and we go to our micro crude oil, we see that our initial short margin is 1,691. And our initial long margin is 1,740. So we're going long one contract and short the other. So does that mean we're going to be paying that margin or having to hold that margin on both sides of this discussion? Are we going to have to hold an initial long margin and an initial short margin to create this calendar spread, which would make it, fairly capital intensive? But if we put this trade on, and so what I'm going to do is I'm going to simply left click on this, and we're going to create an order to sell this contract, right? Which means that we're going to go short the September and long January, and we're going to bring in that premium here, basically. So the challenge to this is we're managing two sides. The advantage potentially in this particular case is that we get a little bit of margin relief by doing this as a calendar spread. We're not holding that margin requirement for both sides. We don't have to hold the initial or maintenance margin for both sides. We don't have to have that initial margin for one and the other. We get that margin relief because the presumption is that if one of these is moving down, the other one's moving in a different direction. It doesn't always happen that way, and you can lose. There is the potential that both of these could go down, and that spread could widen. The potential is that both could go up, and that spread could widen. So there is potential for loss on both sides of this discussion. It is not without risk. However, doing both of these at the same time creates some margin relief in the position, simply because we're going long one and short the other. So I'm going to go ahead and I'm going to send this off, and we're going to look for this to come down in price. We're going to look for that difference between those two to decrease. And I'm going to go ahead and I'm going to send that off. We'll see if we can get into that position. We may have to bump that mark price a little bit. Again, remember, this is paper money, and so this is very likely going to fill at or very near that midpoint in this particular case. So we might have to open up that lock a little bit. And we're getting less now because I was talking through it, and that difference is moving lower already, which is what we wanted it to do ultimately. But, there's still a fair amount of volatility here in this discussion. So let's see if we can get into this trade. Confirm and send will reinitiate its position. I'm doing a confirm or a cancel and replace here to get into the trade, and we'll see if that calendar will fill for us. Now we're opening a position on both sides of this equation. We'll let that sit there. We'll be patient a little bit and see if that fills. Now, one of the other things I wanted to talk about real quick before we get too far away from this is, let me go back here and restore those cells. I want to come back over here and I want to go to /MBT. And this is the Bitcoin futures, micro Bitcoin futures contract. And I also want to look at /MBT, micro Ethereum futures. Starting to see kind of the same type of movement in both of these. But the more liquid of these two contracts is the forward slash MBT. We talked a little bit about this yesterday in the Cryptocurrency Basics webcast. I'm talking about that possibility of a move. So I'm going to come over here really quick. We're going to pop into this grid. Tick size is 5, so this moves in 5 increments of 5. When that tick moves, that's 50 cents. Point value then is 10 cents. 10 cents times this gives us our notional value in the contract. This micro contract, again, has a substantially lower initial margin to hold as opposed to the big contract, which is forward slash BTC, 128,634, 128,634 to go long or short in the big contract. So again, capital efficiency standpoint, this micro contract. So going to the right, looking at this where we are at the moment, maybe looking for this. Let me grab my line tool real quick. Looking for this sideways move here, and we are above that support level. We saw that little excursion below the support level. We've got a resistance level right here that has been in place for the better part of 2 days as we've kind of come right down around this 65 level. Cost to produce Bitcoin is down around the $60,000 mark. So we're above the cost to produce. That tends to act as a drag. But we've seen some moves in this particular market. So what I'm going to do is I'm going to look at the possibility in this particular case of going long the contract if we get a break above this 63,533. Why wouldn't I get in now? I could, but that's going to give me less confidence than getting in on the break of the resistance. So I'm going to right click and we're going to do a buy custom with stop in this particular case. Buy custom with stop. So our entry is going to be right here at 63,534. 534. That's going to be our entry price, but we need to change that to a stop. Remember, that stop's going to get worked as an exchange designated limit order. And then our exit stop or our sell stop is going to be 63,075 is going to be where we're going to exit out of this. 63,075. And that's going to be on a stop. We want to make that good till canceled. And, oh, that's right, because it's 5. So I got to go 63,535 and just line those up. And I'm going to make sure that this is a to close order in this particular case. Click on confirm and send, and we're going to wait for that potential to happen. Not a guarantee that it will, but our expectation is upward movement and a breakout of that resistance level. Initial margin to hold the, or to initiate this position, 2,574. Click on send, and we're going to put that order in place, and it is there sitting, waiting to go. All right, so as we jump over here really quickly, a couple of quick reminders of where you can find more information. You want to find more information about trading futures at Charles Schwab, schwab.com/futures. You can come over here to the Trader Talks webcast page, and you can type in crude oil, for instance, and you're going to see all the webcasts that talk about crude oil. When you come over here, click on subscribe. That's all we ask. Just simply click on that subscribe button if you haven't done so already. And if you are in the Dallas area, we're going to be in Dallas this weekend doing our Market Drive event. And then we're going to be in Orlando on the 7th and 8th. And then we're going to be in New York on the 28th and 29th. And we'd love to see you at all of those locations. Guys, thanks very much for joining me for this webcast. My thanks to Brent Morris for helping out. Thanks for all your great comments. Make sure that you click on subscribe and like. And thanks to our reviewers and our production staff. We'll see you guys again very soon. Take care. Bye-bye.